Everybody wants to know, did the feds take too long to raise interest rates and handle inflation? That's the big question that everybody's handling right now. And we're sitting back, scratching our heads going, how does this affect us? Does it affect me? And is this going to affect continued inflation? Is it going to affect my increased buying power as an investor? How does this affect us? Hi, everybody. My name is Jerome Maldonado. I've been buying and developing and investing in real estate since the late 90s. And today I wanted to give you guys some input and some intake on what the Federal Reserve has been up to in January, moving into February, and what to expect as we move into March. I know you hear a buzz in the news every day on CNBC, Fox News, ABC, any news channel that you guys are after and watching, saying, what is going to happen with inflation? What in the world is going to happen with interest rates? And so everybody is concerned. If you're an investor, you're concerned. If you're a consumer, you're concerned. And the big question is, did the Federal Reserve take too long to handle what's happening with inflation right now? And that's a big question. And one of the biggest reasons is because, as consumers, the average person, I read back several years ago, and the statistic still holds true today, that if 60% of our population, if the increase of their goods and services go up by an excess of $250 per month over the course of 3 months or greater, it will put 60% of our population in bankruptcy, provided that they don't have credit, right? And if they have credit, they're going into debt. Our national debt is increasing, and so the whole thing is bad. And how long can they extend that debt for before it pushes them into bankruptcy? So that's the big question. Now, how does this affect you as an investor? How does this affect you as a consumer and an end buyer? And this is something that I'm concerned with as an investor, as a builder, as a developer, and I've been sitting back going, are rates going to continue going up? That affects how we buy and what we buy, right? So for a lot of you guys, we're going to be talking today about points and interest points. And so we sit back and we go, okay, what is a point? For most people out there that don't understand how the point system works in relation to mortgages and loans, what mortgage points are, they're fees that borrowers pay to mortgage lenders to trim interest rates on a single loan or single mortgage. And so 1 point can typically be purchased from the borrower at about 1% of the loan. So if you have a $300,000 loan at 1%, it'll typically cost you about $3,000 to buy down a point. Now, what does that mean? When you say buy down a point, I remember years ago, I used to think, well, if I buy down 1 point, it's buying me down 1% on my interest rate because I paid 1%, 1 point towards it. That's not the truth. One point will typically decrease your mortgage rate by approximately 1/4%. So if you have a 4% interest rate and you buy down 1 point, it'll typically drop you down to 3.75%, okay? If it goes up by one point and we're at 4%, it's going to typically go up by up to 4.25%, okay? On the contrary. Now, a lot of buzzing around the Federal Reserve and a lot of the presidents across the country running the statewide Federal Reserve. I know that Michelle Bowman, who is our U.S. Federal Reserve Governor, she opened the communication and talk to the potential of increasing our federal interest rates by at least a 0.5 point by mid-March, right? So when we go in and we have our meetings mid-March, there's a few dates that you need to keep in mind, okay? Because these dates are crucial in regards to what's going to happen economically, what's going to happen with interest rates, and what's truly going to happen with inflation. So for those of you guys who don't understand the correlation of interest rates and inflation, this is how it works. So if the Federal Reserve comes in and they say, okay, look, ladies and gentlemen, we are going to increase interest rates. Well, the buying power of the American public it drops, right? So every time interest rates rise, the amount of people that can afford a home at a certain sector, it decreases and it pushes them down the ladder, and their affordability drops. And so because the average American lives month to month, paycheck to paycheck, any time that interest rates goes up, it affects housing prices. Housing being one of the largest investments of all of our U.S. economy. Second is automobiles, right? So anytime interest rates rise, it affects the buying power of the general public with housing and automobiles. The reason that the feds are considering doing such a high increase in interest in March is because of what's happening with inflation, hands down. January was absolutely ridiculous as far as the inflation surge. We saw over a 7% inflation surge, largest in over 4 decades, ladies and gentlemen. Over 4 decades since we've seen over a 7% interest surge. And so the question people have is they're frustrated. They're sitting back going, well, shouldn't the Federal Reserve, shouldn't our federal government have handled this substantially sooner? Why did they allow inflation to go up this bad? And, so you sit back and you think about this stuff and you go, if they would have handled and increased interest rates last year, how would that have affected us? Well, it could have slowed down the economy, because anytime inflation happens, the economy slows down because people can't afford things, right? So every time the interest rates go up, less houses are sold. And since we have a housing shortage and a housing crisis, we sit back and we look and think, okay, how are we going to get this inventory in the market? Well, we're expected this year to have 6 to 7 point increases throughout the year. And so you sit back and say, who decides this, right? Well, the Federal Reserve decides this. They sit back and say, okay, we need to protect the American people from inflation, or at least that's what they're telling the American people. All of this really what it comes down to is it comes down to banking. It comes down to profitability. It comes down to profits. And so the Federal Reserves want to control the economy from having a massive crash, but they also can stimulate it. And people will sit back and they'll ask, they'll say, why would the Federal Reserve want to crash the market? Well, ladies and gentlemen, I've been talking about this a lot, and what people don't realize is that the Federal Reserve is a non-governmental institution. It's not owned by our federal government. It's not a U.S. entity. It's a private entity owned by our central banking system. And so because it's a private entity owned by our central banking system, and so for those of you guys who don't know what our central banking system is, it's the big banks, right? So it's controlled by the Merrill Lynch, the JP Morgans, the Goldman Sachs. It's controlled by our largest banks in the world. And they print money, they loan it to our federal government, and our federal government in return pays them a small interest rate. Where do they get the money to pay back that interest rate to the Federal Reserve? From you and I, ladies and gentlemen. It's called federal income taxes. And ironically enough, the Federal Reserve was created in 1912, and in 1913 was the first year that the U.S. people got implemented federal taxes. So ironically enough, it was a year after the Federal Reserve was mandated and actually implemented. And so very non-constitutional, but it's something that the central banking system took control of back in 1912. And so the central banking system does not want to see the Federal Reserve go away because they control the market. Now, the largest holder of real estate in the world is the central banks. And so, ladies and gentlemen, you're going to your central banks, the Wells Fargos, the Banks of America, the Merrill Lynches, the Goldman Sachs, and you're getting home loans. And so when you're getting home loans, you're paying them back in interest. Our federal government is paying the Federal Reserve back in interest. And so once we get to where inflation goes up so much, what happens is people become very reserved. Buyers are smart. I'll tell you, all these companies are smart. A lot of owners, a lot of executives, CEOs, they're smart, they're intelligent. They can see that buying power has shifted over the last few months. And so as inflation has went up, the buying power has softened a little bit because people aren't willing to spend. They sit back, they'll wait to see what the market stabilizes at. And so the Federal Reserve will adjust interest rates, and this will depict where our market goes. So in spite of what's happening, the bottlenecking of distribution and everything that's happening with distribution right now, prices will start to plateau and hopefully go down a little bit over the course of the next several months if interest rates start to incline, because the market sector will soften in the real estate market, which is our largest sector of revenue nationwide. It's the number one investment that people make is real estate. So as an investor, you sit back and you go, okay, should I wait to buy or should I continue to buy? And how should we deal with this inflation? Well, ladies and gentlemen, there's a few things to consider, okay? And so as an investor, you need to understand, okay, conforming loans max out on residential single-family homes at $647,200 for your best rates, okay? So just know that. So anytime you, as an investor, your loan amount exceeds $647,200, you go into what's called a jumbo loan. And the way those jumbo loans are is typically they're not backed by Fannie Mae or Freddie Mac. And so because they're not federally assisted loans and backed by Fannie Mae and Freddie Mac, typically lenders will increase the rate to protect themselves against default on loans in excess of that amount. And so if you keep your investments under the $647,200, those loans are typically backed by Fannie Mae or Freddie Mac. So on single family homes, you want to consider that. Now, jumbo loans is typically about 0.5% to 0.75% higher than something that is federally backed by Fannie Mae or Freddie Mac under a conforming loan. And so as an investor, if you're sitting back buying high-end luxury homes, because I have friends that do that and they get into the Airbnb and the short-term rental space, they sit back and say, I'm going to get into a luxury rental and I'm going to spend $1 million on this house. Well, this might be the time to reconsider getting into a jumbo loan, and how to decrease that rate is to get into a normal conforming loan so that it sits within the threshold of the federally backed loans by Fannie Mae and Freddie Mac, and instead of going into a jumbo loan. So, ladies and gentlemen, when we buy land, we build houses, a lot of what we tell people is we say, look, when you're going out, stay in excess of $450,000 on your builds. You're outside of the mass majority of people, right? The mass majority, the mean right now is $350,000 for the average median home. And so if you separate yourself and you go just above that, not substantially above that, just barely above that, and you start your builds at $450,000, but you keep them under $800,000. And I traditionally tell people, stay at about $750,000. And here's why. Because then if you stay under $750,000 and you stay over $450,000, you're not going to finance your profit, right, through a bank. You're not going to finance your real estate costs when you sell the house if the house hasn't sold, and you're not going to finance your closing fees if you haven't closed on the house. So between your profit, your closing fees, and your title fees, that puts you down to about $650,000, even at a $750,000 acquisition price to resell that home. So being that you're under that $650,000 mark, the $647,200 mark, you can go in and you can refinance that house if you sit on it under a conforming loan, meaning that you can get the best rates that are available to you because it's going to be a federally backed loan through Fannie Mae or Freddie Mac. And you can go out and rent that property and lease it because you have a better interest rate, you have more profitability, you have the opportunity to have more cash on cash return on your investment under our worst case scenario. So look, ladies and gentlemen, people ask all the time. They say, Jerome, when's a good time to buy real estate? When's a great time to sell real estate? And my answer to them is if you're a career real estate investor, it's a good time to buy all the time, and it's a great time to sell all the time. But how you buy and how you sell is very important to pay attention to. And the question is why? Well, because we want to protect ourselves under our worst case scenario. So everything that we do when we're exercising our investments is related to our worst case scenario. And what is that worst case scenario? Is that worst case scenario you having to hang on to a piece of real estate and renting it as opposed to selling it? Well, ladies and gentlemen, when 2008 hit, I'll tell you that we had to pivot a little bit. So where we were making in excess of $80,000 to $100,000 on every single build that we did, we went down to making $38,000 to $45,000 on every single house that we had acquired pre-recession that we finished during the economic downturn. And it could happen today. It could happen in our up and coming market. So when I teach people this, I say our largest profitability is in this market sector between $450,000 and $800,000 homes. Has our largest profitability. So if we get squeezed, we still make a return. But if you're under the conforming loans, it decreases your payment amounts, decreases your out-of-pocket expenses, and anytime you decrease your out-of-pocket expenses, it decreases liability. Now, in 2008, we were forced to have to lease some of our properties because we were stubborn in selling them, and there was one in particular that we felt we were upside down in. Later, we found out we weren't. But ladies and gentlemen, it's super important to understand that options are key during any economic changes in our market. And so I always ask myself, what's my worst case scenario? How will I deal with that worst case scenario? And if I'm okay with the dealings of that worst case scenario, I'm okay to purchase. And so if I'm okay to lease a house that I built spec that I thought I was gonna make 100 grand on for 1 year and offset that, ladies and gentlemen, you wanna get the cheapest money you can. And the way you do that is these little hidden secrets in the banking industry that most people never learn and fail to recognize to be able to take advantage of maximizing their profits. And ladies and gentlemen, when you understand this stuff, that's how you can go out and invest wisely and always compound your success. If you want more information about the housing market, the evolving economic changes in mortgage rates and inflation, and have specific questions related to these items, please join me on March 2nd at 2 p.m. Pacific Standard Time. That's next Wednesday, live here on YouTube to get all your questions answered and for more detail and in-depth information related to these topics. I look forward to seeing you there.